Hello, hello, everyone. It is March 22nd, 2023, and we're kicking it off with a good Fed announcement today. Today, you've got me just solo, so no Michelle today. And we are just going to go through a couple questions that kind of got sent to me. But yet, as always, you can just throw anything into the chat. Ask me along the way. You can ask me pretty much probably anything today because we're really having a lot of news going on, right? So we had a Fed announcement today. We had Jerome Powell say a few things in his speech. We've had some bank failures since last week. We've had Janet Yellen saying that we've got that they're going to support banking systems. Basically, they're hoping that there's not a run on the bank, because the banking system was a little over leveraged. So, but as far as that's all concerned, we're going to move over on to kind of what's going on in the markets, a general overview, and then we'll dig into some of those questions. As always, throw anything in the comment that you want to ask live. As far as what's going on in markets, so I talked this about a couple members. All right, I talked about this with a couple members a few days ago. Basically, these rallies that happen at the starts of downtrends, and what they feel like and what they're like, and especially with what's going on macroeconomically, where you starting to have that credit crisis type of thing. Yet again, that's really common in the collapse stage, as we've talked about before. So this is basically just another one of those. It's unfortunate, but that's the way that the debt system works. So last year, there's multiple times. There's even one here. We'll draw this up here. There's even another one right there. So regularly, what will happen in these downtrends is you'll get these bounces early, right? So you'll fall over, you'll have the first bounce, then you'll have a flush out, right? And then you'll have one more, and then you'll have the last one before you get some sort of meaningful rally, right? That was a pretty decent one right there. And so, what's going on right now? Well, there's first wave, small bounce, second wave, another bounce. That's been stronger, right? As you can see, this bounce is actually stronger than this bounce. So, just kind of looking at the pattern, just in general, kind of how things are going. So today really shouldn't have been too much of a shock that it ended up going down and that it was a big range, regardless of what the Fed was going to do. Anyways, we have a lot of ground to start catching up. So the back end of the yield curve started to drop out. We've been inverted for a while. M2 supply is slowing down. So there's a lot that's going on in the background. But anyway, so the one question that I kind of get over and over again recently is, how do you know that this isn't a new bull market, right? And I mean, first of all, I don't know if it's a new bull market or not. Basically, as I've always said, is that I look for cycles in the recession, right? So you have your deleveraging cycle, which was pretty much this kind of first half. And then you have that demand destruction, which is when you started to see commodities start to drop and fall apart and things like that. That was in the second half of last year. Then you get the collapse stage, which is what's happening now. And then eventually you get the stimulus stage. So we're still in the tightening phase of things. So we're entering into the collapse stage, but we're transitioning. So we're in this transition, which unfortunately, because we have this transition, we end up getting a little chopped up right now because it's a transition. It's not like it's a clear cut and dry, hey, you're in this stage of the recession, right? There's this transition. So certain things are shifting. You're starting to see like gold picking up. You're starting to see the dollar start to break down. You're starting to see long-term interest rates start to pull back just a little bit. You're seeing the yield curve invert further. So inevitably, what we'll see is the whole yield curve drop down. Anyways, just to give a little bit of guidance as far as where we're at in the recession. one of the questions that I got was, hey, what's the difference between the sleep well portfolio and the awake portfolio? So so this is on our website, right, at etradingedge.com or environmentaltradingedge.com if you want to go the long way. And this is just like a general overview of the difference between the two, but just to kind of sum things up, the Sleepwell portfolio is the non-leveraged, and it's a little bit it's made to be more stable as far as having more assets in at once. So it's a little slower moving. Whereas the Awake portfolio is a significantly faster moving portfolio, or I should say it's more of like a weekly, what's the optimum setup this week. And so what it'll do is it'll push typically into one or maybe two assets on a given week, and it normally won't spread it out very much. Whereas the Sleepwell portfolio, as you guys, any of you guys that are members, you guys saw that there, you can regularly get 5 or 6 assets in here and it'd be fine. There was a long time last year that we were pretty much only in the dollar, but that's not common. Then the other question that we get, which is, well, what's the performance difference, and why have we not seen a big performance difference over this last year between the Awake and the Sleepwell? Well, one thing to always keep in mind is that these two portfolios, not saying that we can't do it a different way, but these two portfolios are long only portfolios, so they don't have any short components in it. So to make money on the short side would be really, really common. And then let's see here. I saw something come through the chat. Today I sent 2 adapted advanced trade alerts, but it was not clear what changed. Can you show the details? Yeah. So by the way, this is the public-facing Q&A. So as far as the Adapt Advanced, since you're a member over there, I can go into more detail as far as that's concerned, probably in the forum or something like that. But as far as what happened today, all I did was update the plan. So there's no change to the trade or anything. I actually had a little misclick there. I sent a second one, but basically I misclicked it. I didn't adjust the trade. I just adjusted the trade plan. So I switched us over onto track B. For all of you guys that are not Adapt Advanced members, that's one of our services where we're a little bit more fluid with the market, and we're using environmental structures to gain our edge and make money on a monthly basis. So yeah, as far as details are concerned, we are still basically in the same structure. We're in the same setup. It's just that the rally was a little bit stronger than we originally anticipated. Not that it got beyond our ranges. It pushed a little bit today, actually. The rally up after the Fed announcement was there, but basically we were still anticipating for the market to finish its push down. And if it doesn't, we'll switch into a different structure. So nothing to note right now. All right, Awake portfolio. One of the differences with the Awake portfolio and the Sleepwell portfolio, the Awake portfolio does leverage up 3x on some of its ETFs, and also it will deleverage as well. So it'll leverage up and deleverage, leverage up, deleverage, pending how it's performing versus its own return profile. That's the difference between those two. As far as there was another question on the calendars. So, what are the calendars? How have they been doing recently was basically what we got here. Let me share this tab instead. So here's our year-to-date returns as far as what's going on right now. So here's the Sleepwell portfolio and the Awake portfolio. We were just talking about that. This is another, as far as like how to figure out what performance is like. So 2020 was a stellar year for us. That was 134% return for Awake, but about 30% return for Sleepwell portfolio. Still one of the higher performing years. That's not very common that we get that high. What's more common is normally around this 23 to 30 to maybe even 40% for the Awake portfolio, and then the Sleepwell portfolio to be right there at about 15 or so. Last year was a pretty dudsy year. we didn't have much to go into, right? It was just the dollar that was doing everything. So it pretty much was null and void. Uh, After this month, we'll get an update on this. I'm sure this will probably pull down into about 0 or so, and this sleep well will be a little bit negative right now. But we're just getting through the first quarter, and then once things actually finally start heating up, we'll probably make some money on many other assets, such as the things that are in play. There's going to be gold in play. There's going to be bonds in play soon. So bonds and gold will probably dominate the portfolio a lot from here on out. And as you guys can see, that we had some EM show up, and that's due to the dollar debasement. So anytime that the Fed doesn't, or anytime the Fed, is slowing down their interest rate hikes and relatively kind of easing a little bit, while we have record inflation, there's normally some sort of debasement of the currency, and that's why gold is spiking up so much. Do you think that the market environmentals are beginning to change now? Absolutely. Yeah, I mean, I think the market environment is dramatically changing. We're moving into the collapse stage. The assets in play are going to be dramatically different than what they were last year, right? They're going to be dramatically different than what they were at the end of last year. So I think stocks in general, we're going to see an earnings contraction pretty dramatically from here. But I will say, on a positive note, right? None of my models are saying it's going to become, horrifying by any means, in fact. So even the pullbacks that we have, just to keep this in mind, we might have already seen the bottom back in, what was it, October of last year. So we might still have pullbacks, and we might not have, we might not necessarily have crashes like what maybe some of us remember in 2008, but that was a deflationary recession, and we have an inflationary recession this time. So things act very dramatically different in an inflationary recession. Gold is very strong. Stocks are a lot more stable rather than crashing. And what we're basically trying to do is all this leverage that came up in the system, we're attempting to we're most likely going to start printing to support the financial system, which will dramatically devalue the dollar and increase gold, right? Or just hard assets in general, even real estate to an extent. Granted, real estate is super leveraged up and high debt right now. So there's some caveats to real estate, especially in office space real estate. So anyways, there's going to be some issues there and stuff like that. So yeah, the market environments are definitely changing. As far as on an intra-trade basis, right? We will most likely probably tomorrow switch into a new environment, in fact. So we'll see about that. It looks like everything kind of got shifted a little bit today, but still we're still kind of macroeconomically in the same thing, where we're hiking rates, but we're not doing it as fast as we were, and now we're just kind of trudging along. Doesn't more printing add inflation? Yeah. So yeah, it's a fun question right there, because there are 3 types of inflation. Yeah, I just said that, 3 types of inflation. So the first type of inflation we'll talk about is probably the inflation that affects us as consumers the most, which is consumer price inflation, right? So does goods and services get more expensive, right? If I, go buy this coffee cup, right? And I go and buy this coffee cup for $1, right? And then next year, if I go buy this coffee cup, it cost me $5, right? That was a lot of inflation, right? That's an insane amount of inflation. So that's kind of what we think about as far as what is concerned as far as that's kind of inflation. And that's supposedly what the Fed targets, right? The Fed targets that type of inflation. Then there's what's called relative inflation. So relative inflation is and we'll just talk about the US per se, right? Because that's kind of where we're basing things on right now. So if the dollar becomes weaker versus other currencies, then you have relative inflation, right? So if we've got, let's just kind of think about this. So relative inflation is where you've got, okay, okay, let's say that I've got the same coffee cup that we were just talking about, right? And then I've got, okay, I've got here, we got this, right? So another piece of glass, right? So you got a glass and a coffee cup. Let's just consider they're the same thing, but this is a U.S. currency, and this is a let's just call it the British pound or something like that. Well, if these two both go up at the same rate, right, and they go up and down at the same rate, they have, whether your consumer price is going up or down, they at least relatively are the same for one another. But as soon as one goes up and one drops down, right, basically this guy relative to this guy is getting stronger. So the US dollar is getting stronger. That becomes relative deflation, and it makes the dollar stronger. But it makes this country's currency weaker, which means on a trading basis, if we buy things from, you know, glass glass country versus coffee cup country, if we buy those things, we can get more because our currency became stronger. And that is normally relative to the amount of debt that you've got in the system. So if you're contracting the amount of debt circulation or currency in circulation, it will strengthen your currency. So that's what we saw a lot last year while we were raising interest rates. And if you weaken your currency versus this other country and they're still tightening, right? Then and you start adding more of your currency in circulation versus them, you'll start to get back together. So as soon as we stop slowing down interest rates or we start printing, then that will change the system. Now that brings us back to the final type of inflation, which is financial inflation. And financial inflation, or asset inflation, is more of what's starting to happen, and that's why gold started to go up. That's why even the stocks are rallying a little bit and things like that, and that's what will probably stabilize stocks. So the debt in the system, we built it up, right? So let's say, hey, I want to borrow this. Hey, I want to borrow this. Hey, I want to borrow this. There's a lot of money being circulated, right? So let's just say we had like $100 in circulation, and that got put into a vault. And then the bank said, hey, we will loan you some money, right? Now we're going to loan out more than than what got deposited, right? So as soon as that gets loaned out, right, then what happens is there are claims for the money that's in the vault, but then there are also loans that are out into circulation that are beyond what the claims are, right? So then what ends up happening is when people come and ask for it, right, you've got to cough up that money, right? But you already sent it out as a loan, right? So then you run into this issue where if too many people ask for money, and you have too much loans extended, then what ends up happening is you get a bank run, right? They don't have enough money to actually fulfill all the claims, right? They overlent. So then what you can do is you can print money to stabilize the bank. That's basically what we just saw. So we print money to stabilize the bank. So we give them money, right, to take care of the claims that they had. Now, what that does is it means that the money that got lent out, now when it gets paid back and stuff like that, it doesn't create deflation, right? Because basically, if I had $100 in the bank and I lent out, let's just say $100 to keep it even, that's $200 in circulation, right? The $100 in the bank and the $100 that's loaned out. Now, if we get people that ask for $100, and then those people pay back their loans, right? You're still only left with $100 inside the financial system, right? So instead of $200 out there, we're now back to the same $100, right? If everything goes back to even. So anyway, so that's how that kind of happens. So if we start to print money into the bank, it basically makes the deflation not happen. And that's what we did in 2008 to stop the deflation in assets and in mark-to-market assets. So that's kind of what shows up on that side of things, but it doesn't necessarily affect CPI. It just affects it has a much more prominent effect on asset prices, really, because then you don't have to sell assets to make due on your claims, right? So no one has to just dump treasuries and things like that. So once you have covered the macro questions, can you explain why different option strikes in the same expiry have different implied volatilities? Woo! Yeah, that's a heavy question. Okay. Okay, let's start off with. Yeah, I'm gonna have to draw this one. So let me get to here. I'll just start from here. All right. Let me. Okay. So let's go through this. This is going to get a little bit complicated for any of you guys that are not options traders, but let's just go with. All right. Turn this into. There we go. All right. So imagine that we have a probability curve. Okay. Most people are used to at least seeing some sort of bell curve, right? So you got, one standard deviation movement, that's roughly 68%, right? You got two standard deviations, that's like 95, right? And then you've got three standard deviations, right? Which is going to be, 99 point some odd, right? Okay. So the whole point behind a bell curve is, in general, what is the probability that anything is going to hit inside of a certain range, right? So if you start looking at options, you'll see that in general, right? Like if we look at a stock, you'll see that the implied volatility is like a U shape, right? So what happens is the ATM implied volatility is, let's just call it, like 20, right? So the ATM implied volatility is 20. And then if you notice, as you start branching out on each side, on a stock, I'm not talking about an index, we'll talk about an index in just a second. So as you start branching out from either side, the implied volatility normally rises on both sides, right? And that's called a V, like a V smile, right? The reason why we have higher implied volatility is because the value of the probability drops down, right? Depending on, let's just call it some recent statistics of that asset per se, right? And then what has to come up to make up the difference between the probability. So, when you're starting to run into like a standard bell curve, right? A standard bell curve does not typically, right? And that's why you've got this V smile, but it does not typically value the what's called tail risk on a standard deviation, right? So the way that the Black-Scholes model works is that it uses, a standard bell curve based on the statistics of the underlying, and because the tail risk is actually higher than what the bell curve actually will compute, in order to make up the difference on the price, because the option is actually more expensive than what the Black-Scholes formula would actually typically would say, the way that it comes in is it comes in into implied volatility, right? So that's why the further you get out from ATM, the more the implied volatility gets ramped up, right? And that's to make up for that difference in tail risk versus the standard versus the standard bell curve. Now it gets a little bit different, and I know you didn't ask this, but it gets a little bit different in here. Let me find my eraser. It gets a little bit different in like an index. An index goes to a whole nother world. So an index will typically look like this, and ATM is right here. So we can still sit there and assume that there's a standard bell curve, right? But it's not a standard bell curve, and that's a terrible bell curve, by the way. But let's just imagine that that's a normal bell curve, right? So the way that the probability of a index works is that the actual probability is higher to one side than the other. So the calls, in the case of most indexes, the calls are significantly higher probability. And because they have higher probability, there is less implied volatility needed to compensate for the difference in probability. And in fact, sometimes it needs less than ATM, which is exactly what we're talking about here. So there's less implied volatility needed to compensate for the price of that option. And then vice versa, because the probability is so low on the backside, the implied volatility actually needs to be raised. Now, that doesn't necessarily always mean that one side is going to be more expensive than the other and whatnot and so forth. But in the case of the indexes, the puts are actually more expensive than the calls, even though the probability of the calls being hit is higher. And that's because let's call it we'll just call it like immediate tail risk, right? So the immediate tail risk is where the ability for the market to flash move deep into the put side, whereas to the upside it's much slower, right? It kind of trickles to the upside. So the way that the statistics work for that, for necessarily for market making, is that they have to end up making the puts a little bit more expensive to start out with because of because of how much deeper the market goes down into the downside. So, anyways, I'm going a little bit too deep into that, but basically, I wanted to just kind of refresh all of that, which you asked there. Why are there different implied volatilities in the same expiration? It's because of two reasons. Number one is that the difference between the bell curve and the implied or the bell curve and the actual tail risk is different, so then they make up for it in the implied volatility. And then the other one is that the statistics for the underlying asset do not match with a perfectly symmetrical bell curve, so then they offset the pricing due to that. Sweet. I'm glad that was helpful. I really tried to simplify that as much as I could without like going heavy into the math. So anyways, yeah, that's kind of how that all goes. So if you ever look at an asset and you can almost just look at an asset, right? You can sit there and go, hey, there's a stock and it's been, chopping up and down, and it's just been kind of like chopping sideways. You'll see a very much like a V implied volatility, and the tighter that chop gets, right? The tighter that chop gets, the more the sharper that V smile will get, because in order to price in the tail risk, right, they have to crank up the implied volatility in it, because the probability of the option starts to drop down. So think about an option of always having two elements in it. It's probability and volatility, right? Oh, thanks. Thanks for that being the best explanation I heard. I really just kind of like drummed that up into an instant moment right there. The tail risk is the market maker. So Yeah, most of the time we kind of talk about market makers and customers as two separate things, but we in some elements we do create our own market as well. So something to kind of think about there, that there's not always some single evil guy on the other side. There's just other people. But so we all kind of want to make money, right? And market makers included. So just let's assume that they're another customer. And the whole point behind this is, if we were to dramatically underprice puts, right, and make them very cheap, right? Let's just say we make puts extremely cheap. Well, then in those really quick flash moves that we were talking about here, you could collect a lot of profit because they snapped into existence really easily, right? Or they snapped into profit really easily because they go deep into their intrinsic value, right? And then if we make them super, super, super expensive, but yet it's rare that we go down into those situations, then of course you've got the opposite side of things, which means you've got all this extrinsic value that gets leaked out, and then the market drops down into it, and then you basically don't have any profit into it. So there's kind of a blend between the two, right? There is the, well, how much extrinsic value can we push into these things while people will still pay for it, right? And then you go for the other side of things, statistically, right? Then you go for the other side of things where you make it so cheap that it becomes, basically almost a guaranteed win, because it's so cheap, because inevitably the market will have a flash move down. And so, yeah, it's kind of a blend of both. And what you can do is you can lay some like just basic general statistics over the market, and basically look at when a market is significantly overextended necessarily to the upside. So the statistics now of the underlying asset is basically assuming the market is basically just going to run up forever, right? And then all of a sudden you'll see that the implied volatility back here is really, really high. Doesn't necessarily mean the puts are really high. What it is it's just saying that all the price has basically leaked out of those things, that the only thing propping them up now is the actual extrinsic value, the implied volatility. It's not so much the probability. And when that starts to happen, sometimes they will be relatively cheap depending on how much that implied volatility is in them based on their probability. Anyways, I'm going a little bit deeper. But the point is that sometimes you can get some really good deals on the put side, even though they are overvalued, per se, for their implied volatility. All right, so so the tail risk is for the market maker or the customer. To simplify that a little bit more, because I realize I went on a tangent there. If you could, okay, let's just say the market goes here. Yeah, this will be a better way to explain this. Okay, so if the market goes sideways, and just let's say it just never goes up, right? And the and occasionally you get these big whoosh, and then we get back, right? And then whoosh, and then back, and then whoosh, and then back. Let's just say that this is how this asset moves, right? So you get these big spike downs, right? These big whooshes. Well, your probability for this asset is, most likely going to be very much into this range, right? But because it has these big flash downs, right, occasionally, you have to price it in like the market is going to go down there sometimes, because if you don't, and the market does go down there, it'll be a dramatic profit for those options, right? So like I said, there's kind of a blend because there's a risk reward factor. The probability is that they're going to lose because it's not often that you get the spike down. But when you do, it's big, it's deep, and it's quick. So it's kind of a blend. You've got to put a lot of extrinsic value in it so it leaks over time, and it kind of evens out the times that get these big blast offs. So the way that puts work are that in general, 80 to 90% of the time, it's a fantastic extra, profit to sell them, right? Because the probability is that the market's going to be up in this window, right? Up in that upper window right there. But the three times out of, let's call it 100, right? Those three times out of 100, it goes really fast, really hard, really down and makes big profits, right? So then what you got to do is you've got to have it to where they're still expensive enough that the, you know, 97 times that they expire worthless, you make enough money as a market maker. I know I just said market maker, that when you lose, when you get blasted on them, that it makes up for all of those times that you were you made premium. So of course, as customers or as options traders, we've tried to exploit that, and we've sat there and said, well, here we'll just sell puts all the time. But then, as you notice, there are occasions where you blow up, right? You hear firms, blowing up because they were shorting puts naked and stuff like that, and they get blasted all of a sudden. And that's because of that risk reward factor that I'm talking about right there, that the probability is that they'll get expired worthless, but then occasionally you get blasted. So it works for both ways. But most of the time it's in the favor of the seller of the option on the indexes, because the probability is that they won't get hurt. But then what market makers will do is they'll hedge with, close to expirations. They'll hedge with, extra pricing, things like that. All right, guys. I think that we've cranked through a lot today, a lot more than I expected to do without Michele. So it's been awesome. I think that as far as as long as there's no other questions, we won't kind of dig into anything else. But yeah, so sleep well difference, awake, I covered that question. The adapt advance guys, I'll say something on the forum here in just a second saying that we basically, we didn't change anything to the plan. It's doing great. The trade's really in a fantastic position. And then, yeah, congratulations on everyone that was that had calendars on today. It was a stellar day. I mean, like we knocked it out of the park today. So, all right, guys, I will see you guys next week. Remember, it's always on Wednesday at 3:30 Pacific, and I'll see you guys there.